The economy of cryptocurrencies, tokenomics, is one of the most important concepts in the crypto world. It explains how digital assets are created, distributed, used, and sustained within blockchain ecosystems. In simple terms, tokenomics describes the economic rules that define how a cryptocurrency works, how value is generated, and why people should trust or use a token. For beginners, the economy of cryptocurrencies, tokenomics, can seem complex and technical. For professionals, it is a strategic framework that determines whether a crypto project succeeds or fails. This article explains the economy of cryptocurrencies, tokenomics, step by step, combining simple explanations with deeper insights, so both beginners and advanced readers can fully understand it. Foundations of tokenomics. Tokenomics is a combination of two words, token and economics. It refers to the economic system governing a cryptocurrency or blockchain project. Every crypto token has rules that define its supply, demand, incentives, and utility. At its core, tokenomics answers three key questions. First, how many tokens exist? Second, how tokens are distributed? Third, why people should use or hold the token. These factors shape the long-term value and stability of a cryptocurrency. The economy of cryptocurrencies, tokenomics, is not just about price. It is about behavior, incentives, governance, and sustainability. If tokenomics is poorly designed, even the most innovative blockchain technology can fail. If tokenomics is strong, a project can grow organically and attract users, investors, and developers. Supply mechanisms. Total supply. Total supply refers to the maximum number of tokens that can ever exist. Some cryptocurrencies have a fixed supply, while others have an unlimited or inflationary supply. Bitcoin is the most famous example of a fixed supply, with a maximum of 21 million coins. A fixed supply often creates scarcity. Scarcity can increase perceived value, especially when demand grows. However, fixed supply alone does not guarantee success. Without real utility, scarcity has limited impact. Circulating supply. Circulating supply represents the number of tokens currently available on the market. It is different from total supply because some tokens may be locked, reserved, or not yet released. The relationship between circulating supply and total supply influences price dynamics. If a large number of tokens are released suddenly, it can cause price drops. Therefore, professional investors analyze supply schedules carefully. Inflation and deflation. Inflationary tokens continuously increase supply, often to reward validators or miners. Deflationary tokens reduce supply through burning mechanisms or transaction fees. Both models have advantages. Inflation can encourage network participation. Deflation can increase token value over time. The economy of cryptocurrencies, tokenomics, often combines both approaches to balance growth and stability. Distribution models. Initial distribution. Token distribution defines how tokens are allocated at launch. Common methods include ICOs, IDOs, airdrops, mining, and staking rewards. Fair distribution is crucial for decentralization. If a small group controls most tokens, the project becomes vulnerable to manipulation. Professionals evaluate distribution data to assess risk and long-term viability. Vesting schedules. Vesting schedules lock tokens for a certain period before they can be sold. This mechanism prevents early investors and team members from dumping tokens immediately after launch. Strong vesting structures increase trust and stability. Weak vesting models often lead to volatility and loss of investor confidence. Community allocation. Community rewards, liquidity incentives, and governance tokens are essential components of modern tokenomics. They encourage users to participate actively in the ecosystem. The economy of cryptocurrencies, tokenomics, increasingly focuses on community-driven growth rather than centralized control. Utility and use cases. Functional utility. A token must have real utility within its ecosystem. Utility can include transaction fees, governance voting, staking, access to services, or rewards. Tokens without clear utility often rely purely on speculation. Such projects may experience rapid price growth, but are vulnerable to collapse. Economic utility. Economic utility refers to how a token creates value within a broader market. For example, DeFi tokens enable lending, borrowing, and yield farming. NFT tokens represent ownership of digital assets. Professional analysts evaluate whether a token solves a real problem, or simply imitates existing solutions. Network effects. Network effects occur when the value of a token increases as more people use it. Social media platforms, payment networks, and blockchain ecosystems all benefit from network effects. The economy of cryptocurrencies, tokenomics, leverages network effects to drive adoption and long-term growth. Incentive structures, reward systems. Incentives motivate users, validators, and developers to contribute to the network. Mining rewards, staking rewards, and liquidity incentives are common examples. Effective incentives align individual interests with the long-term success of the ecosystem. Poorly designed incentives can encourage short-term speculation instead of sustainable growth. Game theory in tokenomics. Tokenomics often uses principles of game theory. Participants are rewarded for honest behavior and penalized for malicious actions. For example, validators risk losing staked tokens if they act dishonestly. This mechanism strengthens network security and trust. Behavioral economics. Human psychology plays a major role in tokenomics. Fear, greed, and social influence affect how people buy, hold, or sell tokens. Understanding behavioral economics helps professionals predict market trends and design better token models. Governance models. Centralized governance. Some crypto projects are controlled by a core team or foundation. Decisions about updates, token supply, and partnerships are made centrally. Centralized governance can accelerate development but reduces decentralization. Decentralized governance. Decentralized governance allows token holders to vote on proposals. DAO systems are a popular example. Decentralized governance increases transparency and community engagement. However, it can be slower and more complex. Hybrid governance. Many modern projects combine centralized and decentralized governance. This approach balances efficiency and community involvement. The autonomy of cryptocurrencies, tokenomics, increasingly integrates governance as a core element of value creation. Market dynamics. Supply and demand. Token price is influenced by supply and demand. When demand exceeds supply, prices rise. When supply exceeds demand, prices fall. However, crypto markets are more complex than traditional markets. Speculation, news, regulation, and technology updates all affect demand. Liquidity. Liquidity refers to how easily a token can be bought or sold without affecting its price. High liquidity increases stability and investor confidence. Projects with low liquidity are more vulnerable to manipulation and volatility. Volatility. Cryptocurrency markets are highly volatile. Tokenomics can reduce or increase volatility depending on design. Stablecoins, for example, use special tokenomics models to minimize price fluctuations. Tokenomics in different sectors. DeFi tokenomics. DeFi projects use tokens for governance, staking, revolutionary base models, on-payment rewards, and yield generation. Tokenomics in DeFi often involves complex reward mechanisms. Professionals analyze DeFi tokenomics to evaluate sustainability and risk. NFT tokenomics. NFT ecosystems use tokens to represent digital ownership. Tokenomics in NFTs focuses on scarcity, royalties, and community engagement. NFT tokenomics is evolving rapidly, combining art, gaming, and finance. Gaming tokenomics. Play-to-earn games use tokens to reward players. Tokenomics in gaming must balance player incentives with economic stability. Poorly designed gaming tokenomics often leads to inflation and collapse. Risks and challenges. Inflation risk. Excessive token issuance can reduce value. Many projects fail because they reward participants too aggressively. Centralization risk. If a small group controls most tokens, decentralization is compromised. This risk affects governance and market stability. Regulatory risk. Governments are increasingly regulating cryptocurrencies. Tokenomics models must adapt to legal requirements. Speculative risk. Speculation can overshadow utility. When speculation dominates, token value becomes unstable. The economy of cryptocurrencies, tokenomics, must address these risks to achieve long-term success. How professionals evaluate tokenomics. Key metrics. Professionals analyze metrics such as market capitalization, circulating supply, token velocity, and staking ratios. These metrics provide insights into sustainability and growth potential. White paper analysis. A project's white paper explains its tokenomics model. Experts examine distribution, incentives, governance, and technical design. On-chain data. Blockchain data reveals real usage, transaction volume, and wallet distribution. On-chain analysis is essential for advanced tokenomics evaluation. Future of tokenomics. Tokenomics is evolving alongside blockchain technology. New models such as real-world asset tokenization, AI-driven tokenomics, and multi-chain ecosystems are emerging. The future of the economy of cryptocurrencies, tokenomics, will focus on sustainability, interoperability, and real-world adoption. As blockchain becomes mainstream, tokenomics will play a central role in shaping digital economies. Summary: the economy of cryptocurrencies, tokenomics, defines how digital assets function, create value, and sustain growth. It includes supply mechanisms, distribution models, utility, incentives, governance, and market dynamics. Beginners can understand tokenomics as the rules of the crypto game, while professionals analyze it as a strategic framework for evaluating projects. Strong tokenomics increases trust, adoption, and long-term value, while weak tokenomics often leads to failure. Understanding tokenomics is essential for anyone who wants to invest in, build, or analyze cryptocurrencies. FAQ: what is tokenomics in simple terms? Tokenomics is the economic system that defines how a cryptocurrency token works, how it is distributed, and why it has value. Why is tokenomics important? Tokenomics determines whether a crypto project is sustainable, fair, and valuable in the long term. Is fixed supply better than unlimited supply? Not always. Fixed supply creates scarcity, while unlimited supply can support network growth. The best model depends on the project's goals. How can I evaluate tokenomics before investing? Analyze supply, distribution, utility, incentives, governance, and real-world use cases. Can tokenomics predict crypto price? Tokenomics influences price, but market sentiment, regulation, and technology also play major roles. If you want to understand cryptocurrencies deeply, start analyzing tokenomics before investing in any project. Share this guide with others, explore real token models, and build your knowledge of the economy of cryptocurrencies, tokenomics. The more you understand tokenomics, the smarter your crypto decisions will be.